And despite the strong Aussie dollar that we have been seeing, there are still prospects of an improvement in the ASX as the year gets underway here in Australia. Market watchers have really got their eyes set on 5,000 points for now, but certainly how much further it can go beyond that is a key question as we check in with our next guest, George Lucas, who joins us this morning from Instreet. George, you are pretty optimistic about the year ahead. I want to tackle that with you, but just on the non-farm payrolls numbers, because this is the backdrop really for our market, the global economic recovery story still. You think there is still some rays of light or some rays of hope within some of the data, is that right?
I think that what we'll see is that we might see the unemployment rate actually bounce back up higher. And that it might go back to the 9.8 level. I think it was a bit of a technical anomaly that happened in December, and mainly due to the fact that the Americans withdrew the unemployment extension of unemployment benefits, and then they reinstate them for January. And so when people, the theory goes, when people are looking for you know, if they're getting unemployment benefits, they'll be looking for jobs, and they'll put their hands up in the survey that they're looking for jobs. And they feel that when the unemployment benefits were removed, that people just said, we're just not looking for work at the moment, and that's what reduced the unemployment rate.
Is it fair to say, though, you're optimistic about the US economic recovery, though?
We are optimistic about the US economy, yeah. Not an employment-led recovery, but we actually think...
A jobless recovery.
A jobless recovery. And we think because of this jobless recovery, the US will have to keep stimulating its economy. And again, you've got to remember that in the US, they don't have these safety nets that we have here in Australia and in Europe for social, so the unemployment benefits run out quite early. And the US government has to stimulate the economy to create jobs so that people get... They're not really designed for long-term unemployment in the US. And so there will always be this pressure, both politically, well, mainly politically, keep stimulating the economy to create jobs.
That's the problem. They're about to default on their debt. They're going to have to vote to raise the debt ceiling because they've been issuing so much of it. Yeah. That congressmen are going to have to come together and change the laws, otherwise the ratings agencies will downgrade them.
Yeah, well, they're not going to default on the debt. The US is not going to default on the debt, so they're going to come to a solution.
Well, I mean, that federal borrowing limit, if you exceed that, they'll obviously have to breach it. I mean, that's significant.
And this is where we're changing now from economics into politics. If you've got 9.8% unemployment, you have a lot of political pressure to keep stimulating your economy, to keep you know, to raise borrowing limits, to do everything that you can to create employment, especially when you don't have a strong social security network like you do in Europe and Australia.
So stimulus continues?
All the way into 2012.
And do you think it works then?
It kind of works. It doesn't. It'll stimulate the economy, and you'll get high GDP growth readings, but you might not get huge recoveries in unemployment. And even the Fed is saying this, and they don't think that the unemployment rate's going to get back to the normal levels for 5 years. But so it's a long time before you get all these 8 million people who are unemployed back employed, but the economy actually starts growing again. And what happens is this stimulus begins to spill out into the rest of the world.
Well, by growth do you mean from 3%, you know, subpar to what?
To like 4%, around the 4, you know, 3.5–4% GDP growth. Yeah, and but the biggest effect is this stimulus spills out into the rest of the world. So Southeast Asia, China begin to move along on the back of the US stimulus. Commodity prices begin to rally on the back of the US stimulus.
So if there's a jobless recovery, though, who is going to be buying Chinese imports into the US? I mean, it's only going to spill out into Asia if Asia has an excuse to ramp up manufacturing.
Yeah, and what we've seen at the moment is consumption you know, we're still seeing inventories getting worn down. So, you know, consumption is still higher than production. And so we can still got some scope for production to ramp up to meet consumption. And over the last, I mean, the other figures that came out in the US overnight were consumer credits. And we actually have seen consumer credit now in the US grow for the last 3 months in a row. So there are signs that the consumer is coming back. And I think retail sales are out on Thursday. And so again, we're going to see whether the consumer is coming back. But, you know, the people who are employed will continue to start buying.
Right.
Yeah.
Okay.
Just on that spillover effect into the rest of the world that you talk about, is that only going to intensify the worries about the inflation problem in China?
Exactly. It's going to intensify the inflation worries in China. It could create, you know, it could put us back to where we were in 2007 with commodity prices, rising oil prices begin to put drags on economy. So it's kind of like a balancing act that's going on. But, you know, these inflationary pressures will dominate the market for the next half in China. There'll be a lot of scares, and this will be one of the setbacks to our market, that will continue to get scared by the fact that China might be tightening. But eventually we'll get over it, and that's why we'll probably see the market rally more in the second half of the year.
How do you trade that?
5,600 though.
Well, that's quite an ambitious level to have charted. I mean, how do you trade it to get there? How do you trade this market confidently, given all that volatility?
Well, at the moment, we think most of the gain will be in the back end. So that you would just buy slowly, kind of like dollar cost averaging, I guess, into the first half of the year. But we think most of the gain will come in the second half. The other part of the gain will become, because it takes time for the commodity prices. There's a lag on these high commodity prices. So we think it's going to be a resource-led
you made that link of a risk of commodity prices rallying too quickly. How do you keep track and make a decision as to what has rallied too hard too fast, George, and what limits as an investor should you be setting?
Okay, well, initially what's going to happen is you have to see the high commodity prices flow through the Australian commodity companies, and that necessarily hasn't resource companies, and that hasn't actually happened. Most analysts never forecast the full effect of commodity price rises into their earnings, and so we're looking to get earnings surprise in the second half of the year for a lot of the resource companies, yeah? And then, we've got, what we do is we tend to watch oil. If oil starts to get above $100, $120, it begins to become in the danger zone that it's going to start causing a drag on the economies. Coal and iron ore, well, coal and iron ore, again, even though we've talked, last week you were a lot of talk about commodity prices falling, the actual industrial commodity indexes, so things that include coal and iron ore, have hit new highs. So there's still a lot of demand for industrial, which is actually quite a good sign that the economies around the world are growing. Yeah. But also back of that's on the fact that the Australian floods caused coal prices to rally as well.
But ultimately you see rising commodity prices as a risk to the rally?
Ultimately, rising commodity prices will be good for the Australian equity market, but a risk to economic growth eventually. Yeah. And that will be, so first of all, you'll see the rally in the Australian market, and then maybe in 2012, 2013, you start to see this slowing down on the back of the higher commodity prices. But I mean, that's what the US wants. They want commodity inflation, and we'll see that as well in at the end of the week when the CPI and PPI numbers come out in the US.
Talk about domestically how the Reserve Bank responds to this. You've talked about high rates doing nothing for the mining sector practically, but then you've said the RBA needs to run the other non-mining economy at below trend. What do you mean by that?
Well, they have a target of growth which they want in the Australian economy. Obviously, the mining sector's booming, so what they do is they're rising interest rates to get the other sectors like tourism, retail, finance to run at subpar by keeping the interest of housing, construction at subpar to compensate for the fact that the mining industry is growing. And a lot of our anecdotal evidence comes from what's happening in housing, retail, and so we kind of feel like the economy is not doing as well as it really is.
But they like that.
Yeah, they like the fact that they're doing that.
And super brief.
Well, they have to do it because it's the only way they control what's going to happen with inflation.
Everything up, inflation's way.
Super brief comment on the European sovereign debt crisis, which we expect might kind of ramp up this week in terms of sentiment of the market. I know you're strong on that, so just a final thought on that from you.
Yeah, and that is a risk for Portugal. They have to accept, they're trying to stop it with Portugal, but the fund isn't big enough for Spain, so they're going to have to do something if they move to Spain. They're going to have to do another solution, but that's another risk.
Yeah, no doubt by the next time we'll speak. There'll be heaps to catch up on with you, George. Thanks so much. George Lucas from Instreet. And after this break,